Assalamualaikum and good day. Welcome back. I am Ima Izzati. In video 1, I have shared with you on the definition of investment, and also I have showed you example of investment concept. In this video, I am going to share with you about when to invest and where to invest. Before that, let us study this wealth management triangle. The triangle suggests that in managing its money or wealth, a person should start with wealth protection first. It means we need to protect ourselves with protection instruments such as through takaful or insurance. We need to protect our life with life insurance, taking health insurance, and if you have a house, you must protect it using home insurance. Next, after we have the protection, then we can accumulate our wealth. You may save for your retirement, for your education, and also emergency fund. Next, if you have extra money, you can accelerate your wealth with investing in stocks, unit trusts, ETFs, and real estate. Lastly, in the pyramid is wealth distribution. So, based on this triangle, when should you invest? Right. You should invest after you protect yourself and accumulate your wealth. It means when you have extra money, then you can invest. However, many of us jump to investment, for example in stocks, with the idea of getting fast cash. It means they buy today and sell it in a short-term period. That is not investment, my friend. That is speculation. One side of investment that many of us tend to forget is risk of investment. When you invest, it means you are using extra money to create wealth acceleration. You must already have life insurance, health insurance, home insurance, and if possible, insurance for your kids and other family members. On top of that, you need to have retirement savings, personal savings, and emergency funds. Sadly, many of us invest their money but do not have sufficient insurance and even an emergency fund. That is very dangerous. Why? Because investment means you are using your own money to create returns. As I said, it has an associated risk. If the risk is high, you might end up getting a small return that may not offset the cost of investment, or worse, lose all your money. So let's say you have money and you want to invest. The question is, where to invest? I'm going to share with you types of investment. If you search on the internet, you will find many types of investments. Majority of them list financial instruments as types of investment, and for non-finance people, readers may not totally understand them. So let me share with you 4 types of investments and its associated risks that you will understand as a non-finance person. First, gold. Ask our mom why they like to buy gold. Mom will answer, "Hey, gold prices always increase. It's difficult to fall." So, what mom is trying to say is gold is an asset which stores value. It means when you buy gold for, let's say, 3,000 ringgit today, in 10 years' time, the value will be minimum 3,000 ringgit. However, since gold price is always on uptrend, it is highly likely the gold price will be more than 3,000 ringgit. Second type of investment that is famous is unit trust, or in bahasa, amanah saham. Before I share with you why it is a good investment, let us understand what unit trust is first. Unit trusts are a form of collective investment that allows investors with similar investment objectives to pool their funds to be invested in a portfolio of securities or other assets. A professional fund manager then invests the pool fund in a portfolio which may include the asset classes listed below, such as cash, bonds, deposits, shares, properties, and commodities. Let me give you a classic Malaysia example. Let's say the government announced that they are going to launch 1 million units of Amanah Saham Digital for RM1 Malaysia each to all Malaysian. It means you can buy as many as you can. Let's say you buy 20 units, Sharifah buys 100 units, Kenny buys 200 units. So basically, what everybody is doing is they invest their money and hold the units of investment. Sharifah's money, Kenny's money, and your money will be collected and pooled by an organization called a trustee. Well, you can imagine trustee as top members of an organization. They will do the analysis and make decisions where to invest. They might diversify the money, and part of it they invest in bonds, part of it in other shares, and part of it in commodities. Is it dangerous investing in unit trusts? It depends. If they are launched by the government, your investment is backed up by the government. It means the government will ensure the investors will not lose their investment. In terms of risk, government unit trust has a lower risk compared to unit trusts launched by private companies. Therefore, in terms of return, you will find government unit trust return will normally be lower than the private company unit trust. Third type of investment, real estate. I put this in the list because many of us would think real estate as investment. Well, the real one here, real estate can be a good investment and can also be not a good investment. Let's see why real estate is said to be a good investment. This is based on the perspective that a house is always on demand because of the rising population. It can be a good investment in two ways. First, you buy a house and you rent it. In this case, you can get good cash inflows. Second, a house can be a good investment if you decide to sell it at a price higher than your buying price. We call this capital appreciation. But when can a house be a bad investment? This can happen when you cannot sustain good cash inflows and have to bear maintenance and repairing costs. Remember, not all tenants could take care of our house like theirs. You might end up having to use your money to maintain and repair them. A house can also be a bad investment when it experiences what we call as capital loss. It means its selling price is equal or lower than buying price. This could happen when the location is not strategic or when the economy enters into recession. Fourth type of investment is stock. This instrument is so popular that many jump into investing in stock without understanding what stock actually is. What is stock actually? Stock is also known as share. It represents ownership in a company. It means when you buy stock, you own a fraction of a company. When people say they play stock, what they mean is they buy stock of a company in the stock exchange market, hold it, and sell it. Like any other investment, investing in stock has its considerable risk too. In fact, the risk is higher than any other investment that I shared with you previously. The reason is simply because the stock price is very volatile. Therefore, there is a high chance of your return to be uncertain too. So everybody, I have shared with you 4 types of famous investments that always being discussed or heard in our country. There are many more investments outside there, and remember, all investments have its own risk. If you need to invest, you need to study the type of investment and its risk. Once you know the risk, manage them so that you will not end up losing the money you use for investment. So remember guys, invest with intelligence, not emotion, okay? Till I meet you again, take care.